Welcome back to the Wolf of Queen Street podcast series. Welcome back to the audio podcast or the video series. But before we get in today's episode, I just want to do a shout out to my sponsors, JobSearchQLD.com. Job Search Queensland is a company that helps you find the right career path, help you get ready for the next interview, get your CV ready, and assist you with everything when you got to move from one job to the other. Some of us at the current time in the world at the moment have struggled and unfortunately have lost our career or path, and we need some guidance. JobSearchQLD.com is a company to go with, and they will help you out, no questions asked. But today I've got Matt Harris, from the Managing Director from Lighthouse Financial, my personal accountant and someone that's been on the show before, because in the last 72 hours, last 3 to 4 days in New Zealand property, there has been a major bombshell announcement by the government. And I called up Matt as soon as this was announced, and I was lucky enough, Matt took my call. He was a bit stressed, and I said, Matt, we've got to get you back on the show. We've got to do a video. We've got to do a discussion about this new policy that's done and what it actually means. So we're not talking bullshit. We're not talking noise. We're talking the actual policy and what that means to a person that owns a property or wants to look at a property, so we can clear that all up and it's precise to what we're doing. So Matt, welcome to the show.
Thanks, Warren. It's good to be back.
So one thing I wanted to say before, as well as we get into it, as a couple of side notes, is there's, as much as we're going to discuss all of this into today, there's something as a little golden egg at the end of the episode. So we're going to be giving away a massive prize, $1,000 prize at the end of the episode. If you pay attention, something that's really important to myself and Matt, but I'll let you know at the end. So you've got to stick around in that. And something else I wanted to say that I thought would make Matt smile today was, a lot of people notice I'm not wearing my hat. I always wear my branded hat. I'm a hat and a peak guy, but I'm having one of those good hair days. And Matt would appreciate that. When you have a good hair day, you don't put anything on top of your head. So before anyone tells me I'm not wearing my usual hat, I'm having a good hair day. So please leave it alone. But Matt, so obviously the Labour government in New Zealand made a major announcement. I'm going to read one policy to the next, and I'll allow Matt, as I said, he's the Managing Director of Lighthouse Financial, my personal accountant. He's an accountant for property investors, for property, and has been for, I don't want to give away your age, Matt, but a very long time. And I'll allow him as the professional to tell you what it means and what the impact actually is.
Okay.
So we're going to get stuck into the first one from the policy. Like I said, I'm going to read it out, and then Matt's going to give his feedback onto what the policy stands for and what it means as to anyone out there looking at the moment. So the first one at the moment is a little self-explanatory what it is, but it's the $3.8 billion fund around infrastructure for housing.
Yeah, so you hit the nail on the head. It is self-explanatory. Effectively, it's a fund that the government has put together to try and deliver housing outcomes. So that's going to be social housing, that's going to be infrastructure to support increased houses being built. Mm-hmm. And I think part of it is also going to be higher volumes of consenting and more streamlined consenting process.
Yep, that's great. And the second one that they announced was more access to the first home loan grants and loans.
Yes, so what they've done is increase both the income threshold and the house price threshold, basically to allow a higher proportion of earners to buy houses.
Are you talking about, are you talking about first home buyers around here?
Yeah, so it's around the 5% deposit. It's around the amount of income they can earn to be eligible, or before they're not eligible any longer. Yep. And it's also about the cap on house prices, which houses that they can purchase before being ineligible to use that scheme.
Okay, that's great. So to anyone else, in the sense of saying that, what Matt was coming across is just they've shifted the bar on how much more money you're accessible to, depending on your income, as well as how much they'll loan to you from what it was before, as well as reduced 20% deposit for first-time buyers to 5%. Is that what you said as well, Matt?
Yeah, that's right. And effectively what they're trying to do is acknowledge that the housing market has moved significantly, mm-hmm. and that the thresholds previously in place weren't enough in their opinion.
Yep. And one thing, Matt, I just wanted to go into this one before we get into the next policy. These caps that have been increased, are they the exact same? Because people will be asking us, are they exact same across the country, or are they specific city to city?
No, they are specific region to region.
Great. So anyone that wants to find out would have to go and take a look at where their region is and the impact or the increase in that region where they are.
Yeah, that's correct. To give you an idea, though, the cap in Auckland has now been lifted to 625,000.
Okay, awesome. The next one that they've come into it, we've already spoken about the increased income caps, the higher house caps. The next one is one of the ones that's a big question at the moment, is the bright line test that has been doubled. So before we get into the bright line test that's been doubled, just to anyone that's coming across as the first time, Matt, can you explain actually firstly what the bright line is and then the impact of it doubling?
Yeah, absolutely. So the Bright Line test has been around since 2015. Effectively, New Zealand has an intention-based regime, which means that your intention when you purchase a property ordinarily would dictate how it's taxed. Mm-hmm. What the Bright Line does is it kind of overlays that and it says, regardless of your intention, if you buy and sell within a certain period, you will pay tax. So originally it was 2 years. And then in March 2018, it rose to 5 years. Mm-hmm. And as of 27 March 2021, it will be 10 years for existing properties. However, of note, it will be 5 years for new builds.
Okay. And so that means fundamentally, if you buy a property at the moment, not new builds, and you sell it within the next 10 years, you're going to be paying tax on that, on the profit or the difference of what you paid from it. Is that correct?
Yeah, that's correct. They're going to take the sale price and they're going to take away the cost price and some deductions for real estate fees and that kind of thing. And you're going to pay tax on the net profit.
What do you, from your opinion and expertise in this area, what do you think the impact will be around this specifically? What do you think there could be an up or down or benefit or a decline around them increasing this to 10 years?
Yeah, I think what it does is it significantly reduces flexibility as a first point. So if anything happens in a property investor's life, maybe they lose their job, maybe there's a death, some adverse event, what it means is those people are not going to be able to sell that property without triggering a tax event. Mm-hmm. So it's very close to a quasi capital gains tax, and that you have to wait a very, very long time to get outside that bright line period now. And so I think the immediate impact on the market is that people are going to, first of all, not be able to restructure from one entity to another for various reasons, such as protection, sometimes for taxation. And also I think people are going to carefully consider their entry into the market and also the entry out of the market, because entering the market from the 27th onwards is a 10-year commitment. Mm-hmm.
Yeah, and totally. And is there anything in the policy that's put into place that will allow, you spoke about those examples of real world situations, right? COVID, death, and family. Is there any situations that allow for deviation, or is it straight, there's one policy and that is it? Yeah,
so at this stage, they have retained the exemptions that previously existed, which were matrimonial rollover relief. So if you split up with your significant other and your ex-significant other and you have to transfer the property on, that won't trigger it. Mm-hmm. Also, they've retained the exemption for inherited properties. So after you inherit a property, you can sell it immediately without facing tax, and that just follows New Zealand's intention not to tax inheritance.
Yep.
Although, that could be next at this rate. And the other little thing which is quite interesting is they have amended the owner-occupied part of the Bright Line rules. Mm-hmm. And it used to be kind of an all or nothing test where if it was your main home and you had no other main home and you sold it, you wouldn't be taxed. Yep. Now they're going to do it on an apportionment basis, how long you lived in the house versus how long it might have been an investment, and that's how much tax you will pay.
So can you give me an example of that, the home, your one home that could play out? Because at the moment, I'm thinking I own my personal home, I've moved in within a couple of years, or is it in the sense of someone that's bought their first home, but they're actually still renting and they're renting out the one house they own?
Yeah, I think it's going to get a lot more difficult to find. I actually had a phone call with a client today. They had a house in Epsom, they lived in it, then they moved to Rotorua to live in their partner's house.
Yep.
They've only been there a year. They have no other houses. She's got a tenant in there and she wants to know whether she can sell that and not face tax on the gain under the owner occupied exemption. And to be fair, it's not very clear. In her case, it's probably 50-50 because a main home is the place you have the closest association with.
Yep.
And arguably, if she's living with her partner, despite the fact it's not her home, that could be a problem.
So, from your opinion, professional opinion, there has to be further clarity put into this rule around this space, around that.
Yeah, and we've got to remember that there was very little warning of these changes, or no warning, and also no consultation.
Yep.
So advisors like me are pretty much blindsided, and they've issued a couple of 2-page fact sheets with some brief answers, and we have to rely on those to calm our clients down and try figure out what the best approach is moving forward. I fully expect there to be some commentary over the next few months, but for now it's very limited. Okay.
So we're going to get into the next point, and I think this is the biggest discussion point of the last 72 hours that has come out of it, and it's the main point that people want to know and understand and haven't got clarity on at the moment, and fundamentally why everyone will be wanting to watch this episode, I'm hoping. And it's something I'm going to say it's the interest deductibility removal, or removal of interest deductibility. And I'll let you, Matt, say exactly what it is, how it should be mentioned, and what that impact is as well.
Yeah, so this is pretty major, Lawrence. I think I've been working in tax a little while now, and this is one of the more major changes that I've seen. And again, the non-consultation part of it is quite brutal for property investors. They didn't see this coming. And it kind of feels, with all the other changes that happened over the last 2 years, that they just keep getting kicked when they're down. So what it means is the government has said that from 27 March onwards, if you purchase an in situ property, so that's a property that's not a new build, you will not be able to claim a deduction for any interest costs on that property whilst it's used as an investment. If you have an existing property which you already own, before then, you are able to continue to deduct interest, but it will be phased out over a 4-year period up to March 2025, in which case your deduction for interest will be zero.
Okay, so, to anyone that's listening at the moment, what does that, that is the policy that's been implied. What does that mean to someone like me that's an investor, or someone else that has one property as investment? What does it fundamentally mean, the impact as either existing or when I'm buying new at the moment?
Yeah, so let's start with new, because it's easy. What that means is that you're going to have to think very, very hard about the cash flow profile of that property. And that's because you will be taxed as if you didn't pay interest. And if you paid principal as well, not only you won't get a deduction for principal, obviously, but you also will not get a deduction for interest. So you're going to have a very interesting outcome where your profit and loss is going to look really, really good, but your cash flow is going to look awful, if not negative. So what it means is that if I go out there today and I'm looking at buying an investment property, and I know that I've got to hold it for 10 years because of the new Bright Line, I have to consider what my cash flow profile is over the next 10 years, because it's realistic to assume that I will be paying the shortfall out of my pocket, out of my other earnings, so out of my salary and wages, for example. So that's new purchases after the 27th. For existing investment portfolios, I think there's a little bit more time to take a breath and figure out what your next move is. And that's because for this current year, we're going to have 100% deduction. The next year is going to be a transitional year, which is nearly 100% by the time you do the math. And then by the time you get into the third year, we're going to be down at 50%. And we're probably going to be in election year. So it might be that there's a change of government, a softening in policy, maybe the market has shifted a little bit. So I think people who already have a portfolio don't need to panic at this time. The worst thing that you can do in a situation like this is, run out and put all your investments on the market. But it has a significant impact for investors, and it will change the cash flow profile significantly.
I totally agree with that. We did, not to scare anyone or too crazy, is the moment this was announced, we went through, I sat down with one of my mentors, and we did a calculation, and it was a 78% reduction in my cash flow. This policy. So not that this won't be the same next week because I currently own the property, but this was as if it was in 5 years' time. The cash flow as it stood at the moment was a 78% reduction to what I have at the moment. But I think one thing, Matt, what we'll do at the moment is we'll just give a generic example of how is that explained, right? So let's assume I buy a house in Auckland for $1 million. It's a standard 4-bedroom house in Auckland. That's going to cost me, when you use 3% as the interest, right? 3% is a little bit higher than what it is at the moment, but it's not unrealistic. So that's costing me $30,000 a year. I've got a 4-bedroom house, and so I'm renting it out at about $800 a week. Again, that's about average. So I'm making, what's that, 41,600 a year in my rent.
Yes.
Let's take away a round number of $5,000 for rates, property management, and everything else. So theoretically, I'm making about $37,000 a year. Correct?
No, so you're making a year.
Income.
No, 20.
Yeah, your rent.
Yep. 46. So yep. Hold on. Let's make sure we get the math right here, right? So 800 times 52.
Yep.
41,000.
Yep.
So you're making 41,000.
Yes.
You're taking away $30,000 for interest, and that's assuming no principal deduction, right? So you're
Correct.
at 11,600. Then if we take away $5,000 of expenses, you're at 6,600 net profit.
Yes.
Ordinarily, you would pay a third of that in tax. So call it $2,500, maybe.
Yes.
A good outcome and the standard economic outcome for a business operator. You have your income and you have your a suite of deductions which are connected to that income earning process, and you pay profit on tax on the net. In this case, what we're going to do when we get to tax time under this new policy is we're going to add back the $30,000. So your taxable profit will be $36,600. And your tax on that, instead of being $2,000, is going to be well over $10,000.
Yep. And that's where that change, so if you listen at the moment, that's where that change of 78% to impact on myself was that instead of me paying $2,000 tax at the end of the year, I'm now paying, I think it's just around about $12,000. So it's 33 cents on the $36,000, which is about around that number. And that's what the difference is in this calculation. So,
and it's major.
Yep. And it is major. But as Matt says, if you got existing properties at the moment, it's not that way next week. It's only for new builds. For existing property owners, it's taken us about 4 years to get that path. So we have some time to consider it. But it does mean it's a drastic mind shift change to anyone that's wanting to look at new properties at the moment, because fundamentally your calculations a week ago before this policy of what is a good investment is fundamentally flawed now because your numbers are drastically different.
Yeah, and anyone who has a P&I mortgage, so a table mortgage, that principal does not even come into that profit and loss calculation we have just done. So that would be added on top of the $10,000. So you can see how there's scenarios out there where the cash flow is negative, but the taxable income is positive by a long way.
Yeah, and that was one thing, Matt, that I wanted to ask with you as well. You're a specialist in this, in the sense of Auckland. Let's again use Auckland as an example. Auckland's a very expensive city. It's the most expensive city in New Zealand. People are paying a lot. The rent is high, but relative your gross yield or your income to your debt and your return is not as high. So a lot of people in Auckland would be break even current under the old policies, or losing a little bit of money, or negatively geared. Let's say that they're losing $2,000 or $5,000. Now, if you're losing $5,000 already, is this going to make any impact to you because you're already losing money?
Yes, of course it is. So we have two kind of pools of investors on our books, excluding developers and traders. We have cash flow investors, so they are usually going for lower capital growth, higher yield properties.
Mm-hmm.
Having said that, those properties still have growth, or we've got high capital growth, lower yield properties, and I characterize them as leveraged investors.
Yep.
So for leveraged investors, this is a very big issue because, as you pointed out, probably their portfolio is about neutral,
Mm-hmm.
and that's with the deductions. If you take away the deductions, their profit is positive and their cash flow is very, very negative. So those are the people that, unless they have a really robust income outside of their portfolio, are going to have some trouble, and are probably the ones who will have to offload properties. Notwithstanding that, they'll probably be taxed on offloading those properties under the bright line rules.
Yep.
The cash flow investor has a little more room to move, but the reason that those investors invest in those types of properties is mostly lifestyle related. So on the leverage side, it's usually retirement savings, it's wealth creation, things like that. But on the cash flow side, it's definitely more lifestyle driven. They want free cash flow so they can go and do things other than work.
Yep.
And they still go through a wealth creation cycle like the leveraged investors. It's just they don't expect as much capital growth at the end of it.
Okay.
So yeah, that's in summary, it is going to definitely affect one set of investors more than the other.
Okay. And the last point, one of the last points of the policy before I have additional questions on top of that. And if anyone is listening at the moment, if I don't mention one or two smaller things of the existing policy, it's not because we don't want to discuss it. It's some of them are quite self-explanatory. But the last point of the policy I want to bring out is this, that the new builds have sort of they're trying to make it that in New Zealand, we need to build new builds because we've got a shortage, and therefore the government's bringing in these incentives that if you build a new build, if you buy a new build at the moment, if you buy a new build, the bright line test as well as the interest deduction changes won't apply to yourself. So they're saying, hey, go buy the new builds and we'll keep it a status quo. So love to know your thoughts on this, Matt.
Yeah, so I think, this is one area where at least the government have some sort of clue.
Mm-hmm.
We have a major supply issue in this country. It's very hard and expensive to build houses. Our infrastructure is not up to intensification, and our councils are very slow. So the government's got, they are right in that we need to increase housing supply. Having said that, they're kind of hitting the demand side at the moment on the head. Property investor will stop you. So the thing about the new builds that is worth pointing out is, yes, the bright line is set in stone. That will stay at 5 years. Interest deductibility is currently only proposed, and the government is going into consultation currently to see whether they will allow that. And whilst I agree that new builds are needed, I think that when you do something like this in a tax system where you segregate a certain asset class and you encourage people to go one way over the other, you go outside the principles of a good tax system. And a good tax system is generally built on what they call horizontal and vertical equity, which means that you treat two people in the same situation the same way and two people in a different situation a different way. And I think this goes against that kind of basic premise of a good tax system.
Great. And one thing
my opinion, Lawrence, is that they probably will pull through and come with interest deductions for new builds, which I think is a little shining light, especially for investors out there who might have a subdividable section with one house on the front. They could easily build a house on the back and load some debt against the back house and sort of carry on in a semi-leveraged way. So I think there's opportunity wrapped up in there.
That pretty much leads me into the next question. So those are sort of the policy stuff that's been mentioned, the main crux of the policies that's come out. Questions I have to you, Matt, at the moment is the first thing that any investor is going to ask is, hey, Matt, what are my options? What are my options, and then what can I change to negate some of these policies if I have any options to negate them?
Yes. So we've got a little issue with the time period the government has given. So 27 March is obviously very close. So in an ordinary course of business, I've been running around actually for the last 2 days, finishing up restructures and things. So what we're trying to do is where possible, we want any properties to be owned in tax efficient structures, and that's structures that allow you to get income to the lowest earner in your family group or your business group. And that's simply because we know after these rules, every property investor in New Zealand will have a tax bill. Unless they don't charge any rent for some reason, which obviously is non-commercial. So we assume that every property investor is going to have a tax bill from now on. So there's a high interest there to have it in a structure where you can direct income at your wife, for example, who doesn't work and she's on a 10.5%. So if you are buying a new property after 27 March and it is not a new build, then we would definitely be looking very hard at tax efficient structures. Outside of that, I think that making sure that property investors just really keep a close eye on the costs that they can deduct. So a lot of investors, for example, don't have chattels valuations. A lot of investors don't claim home office expenses. They don't claim mileage to view properties. All those little deductions are going to become vitally important. Outside of that, there's probably some more aggressive moves that clients and business could make in terms of shifting debt onto business assets, commercial buildings. If you've got it, and you can shift debt onto the commercial buildings and delever residential portfolios. And then I think that the smart thing, and this is actually where I think the good property investors, and I feel like there's a lot more professional property investors out there nowadays who are well educated, who watch shows like yours and other shows, will be able to pivot quite quickly. They'll realize that there's opportunity here, and it might be that subdivided section where they build a couple of townhouses on the back to keep. They stay within the new rules. As other older properties come out of Brightline, they might decide to shift those along and build some more new builds. So I think there's opportunity out there, definitely. And there will be options for investors. So when they ring me at the moment, first thing is don't panic. You've got time. And the second thing is that the fundamentals of property investment haven't actually changed. It's still long-term wealth creation.
It totally is. One of the last things I wanted to find out from you, Matt, was I love that you mentioned that there is the ideas of how you can shift the income and shift where it goes into the lowest income earner, having in the right structures. To anyone that's listening at the moment, this is where Matt, an accountant, your specialist, comes in to do that. That's where you go to those people to do those exact options. Is there, I've seen a few things floating around and people coming up with weird ideas. Is there any other way that you can actually change your property in a way of that'll get around it, not just from the way you set up your income and your business side of it, but is there a way that you can change it? For example, people from a house to a Airbnb or to a flat system. Is there any one of those sort of investment types in property that would negate any of these policies as well?
Yeah, so they've come out and actually said that using it as a short-term accommodation is not going to get you around the rules, and which, fair enough, because that's where most people are going to go straight away. And there's already we have the mixed asset rules which apply to things like beach houses that are sometimes rented and sometimes not. So I think the short answer is no. If you are lucky enough to be in business and or have a commercial building, I think there's definitely opportunity. Outside of that, I think that what you want to do is just make sure that you've got everything really tight. And I think the obvious thing to do as a property investor is about to have to spend more money to own an asset is to raise rents, so increase the income stream. And I think there's not many people who don't agree that rents won't rise on the back of this. All economists agree. I think the natural thing is that rents should go up to cover some of those costs. But I think there's going to be a bit of a double-edged sword effect in this new rules in terms of trying to help first home buyers. First of all, rent's going to increase, so it's going to be harder for those people to buy deposits. Save deposits. And then we're going to have first home buyers who are going to buy a property that was formerly an investment property, but an investor's offloaded it because they're a leveraged investor and they just can't make it work. So what that does is that it takes housing supply away from the rental market. So it puts more pressure on the rents, which puts more pressure on the people if you pay it to save, and the whole thing kind of doesn't make a hell of a lot of sense. And if we go back to the house caps, I haven't seen many houses in Auckland for 655,000. Have you?
No, not a lot.
So I kind of look at it and I go, yeah, nice try, but there's, I think if you go on Trade Me right now, there might be 10 properties for sale at that price, so it's a bit short-sighted. And I think that if you look at that and you go, okay, if we have our worst case scenario out of this, which is that property prices drop 10%, which some economists have come out and said they expect that might happen, that will only take us back to the prices at December this year. So if you couldn't afford a property in December this year, you can't afford one now.
I think that, that was one of the interesting ones that I saw from a personal point after this announcement was everything came out and it was like, hey, we're going to try and help the first time buyers and stuff. And everyone I've spoken to and everyone I've listened to, obviously I'm not listening to the people that were having a rant about the policies. By all means, the policies suck and the government, unfortunately, I don't like saying it on my show, but the government has no idea what they're doing in this situation. But talking to people about, did this actually help you? Will this actually help you in the next 3 months or 6 months get into your first home as a first-time buyer, whether you're 19 years old or whether you're 90 years old, irrespective of your age? And the biggest thing was all of them turned around and went, no, not really. And that was the craziest thing, that the one of the most drastic housing policies announced since I've ever, from most people's expectations around property, that was supposed to help one area has only maybe in a minuscule been able to help them. And that's a sad point, Matt. We want everyone to have equality and the opportunity to, by all means. Look, as an investor, I've got no issues as an investor for the government to say, hey, investor, you're making money, pay a little bit more money so we can give opportunities over here. I have no problems with that. But totally stonewalling one side and not having a benefit on the other side realistically just seems unrealistic and and not in touch with the real world.
I couldn't agree more, Lawrence, and I think it's pretty telling that if you go out there and you have a look on the forums and on the in the media, there's no groups apart from the government who are supporting this as a good idea. No first home buyers have come out and said this is great. No economists have said that this is a good idea. And property investors certainly haven't said it's a good idea. So when you see this kind of, the normal person in the street going, actually, I think this isn't quite right, it gives you a pretty good indication that probably it isn't right.
Yeah, totally.
I agree with you. Maybe tax investors a little more.
But at the end, Matt, and that's sort of the policies we covered off in as well. But there was something I mentioned right in the beginning of the show. We don't want to end off the show on a flat, and on a flat sort of note. That's not the way I like it. And I said off in the beginning of the show that there's something special that we're going to give away. One thing to take from this anyway, and Matt said in part of the show, and I'll let him have a discussion further, is investors that are going and knowing what they're doing and have driven high cash flow. To us, cash flow is king. Is the most important thing. Cash flow is king. It will impact us, but we will still have opportunities, and we won't have to make drastic changes and things like that. And this is where it leads into the education that I've been provided and around what I know and what I do in investment. And this leads into where my sort of giveaway is. But before I get into that, I would love to know, Matt, your thoughts about the cash flow and education out there and getting the right expertise to become an investor as well.
Yeah, I think we're in a really, really good place as a property investor at the moment. There's education available, financial literacy is rising, and people understand that property investment has to be treated like a business if you want to be successful, because you're dealing with large amounts of money. Fixed assets, which a property investor with 3 properties has probably a larger capital base than most small businesses in New Zealand. And obviously, we're dealing with risk, as Tuesday's announcement shows us. So the importance of education and where it can get you as an investor is, I think there's Grant Cardone, who's a favourite of mine, Be Obsessed or Be Average. He says, if you've got any money, spend it on education first, then build your portfolio.
That is so true, Matt. And, and that leads me into, as I just dropped my pen there, that leads me into sort of my giveaway I was talking about at the beginning of the show is, so I'm a big, as people know, I'm a student. I've been educated by a company called Wealth Mentor. I've had majority of the team on board. Matt is actually one of the power teams to people within Wealth Mentor. Wealth Mentor is Australia's largest property education provider. So they provide you the education, the skills, how to invest. There's no hooks or anything to sell your property. There's no hooks or anything else. It's fundamentally the education. What I use, a lot what Matt uses, Matt's part of the team as well from the power team point of view, to show you how to get into it and to show you how to do it the right way so that these policies that come in now is, as much as they're bullshit and they're horrible and should never exist, means that you're not going to be caught out at the end. And the special deal, what we're doing is, Wealth Mentor normally do an in-person 3-day cash flow masterclass, 3-day events. But due to COVID, we do the events on our virtual live. The next one's on the 16th, 17th, 18th of April, so a couple of weeks away. For anyone that wants to go into it, it's $1,000 entry ticket to get access live to the 3-day event that's hosted by Wealth Mentors, all their mentors. So Matt usually sometimes is on there as well, all of some of his key members as well. And what we're doing for today's episode, to just end it off with a little bit of positivity, bit of stuff, is we're giving away a ticket, $1,000 ticket away to that 3-day event for yourself and your partner to come and get the property education, to come and get further education. And I talk about further education because I became a student after 10 years of investment with this company. 10 years investing, I went over to Wealth Mentor, and I still learned so much, and I use those policies today. And I would love to know, Matt, you've been around Wealth Mentors and what they've done for the last good few years. Know what your thoughts are on the education that they provide.
Yeah, look, I was originally approached by Wealth Mentors just to come up and speak to some of the clients about accounting and property taxation concepts. And it was really clear to me early on that it wasn't an outfit that just tried to sell you something or wanted something for nothing. And
yep.
I myself already was an experienced property investor before I went there, but having been part of that process and seen some of the things that they teach and been at events, and then also dealing with probably 400 or 500 clients over the last 3 years that have done the Wealth Mentor training and helped those people. Some of them have built very, very large portfolios. Mm-hmm. I have personally learned a lot more than I already knew about investing, and I can't rate it high enough. It's a very, very good educational product.
That's amazing, Matt. And just to let anyone know that is interested in entering that competition, it is as simple as, if you're watching the YouTube video, you should drop a comment below of what your financial goals is in the next week, month, 12 months or 2 years, and that gets you an entry into the competition. And I'll be doing the draw within about the next week. The details will be in the description for the YouTube. If you're listening to the audio podcast of this, by all means, come on find me on YouTube under Lawrence Lots or the Wolf of Queen Street and drop your comment in there as well, because that is how you're going to enter to be have a chance to win this $1,000 giveaway. Just to let anyone know that's close fans of the show, I've done this twice before. Both those people that won the prize currently now own property. They got the ticket. They went to the event. That is in the last 6 months. Both of those couples have now got investment properties underneath their belt from that education, from this free ticket they were giving away. So don't waste your time. Enter the competition and your life will change. But Matt, at the end of the day, you've provided so much insight, so much everything else. And I'm sure there's a lot of people that know about you from our show. There's some people that won't know about you, the show. Please, can you tell them where can they find you and where can they reach out to you if they have any more questions about this?
Yep. So I'm always happy to answer questions. I speak to property investors on a daily basis. I'm involved in lots of property transactions. You can either give me a text or a call, 027-257-4071. Email me, Matthew with 2 T's at lighthousefinancial.co.nz, or you can just go to our website, lighthousefinancial.co.nz, and have a little look around. You can see all the things that we can help you with.
Great. Thanks so much, Matt. And is there anything, before we end it off, is there anything you want to leave the audience with today? Is there any last couple of golden nuggets for people to think about this announcement and their journey over the next couple of days or couple of months?
Yeah, I think so, actually. I think it's really important that any property investors who are watching this that have already built a portfolio and are marching on their wealth creation journey is don't give up, don't panic. This isn't the end. I think if we all think back to March last year, we were sitting in webinars like this, theorizing what would happen as a result of COVID, and probably everyone in those webinars in the back of their mind thought, actually, this could be quite bad. But we all sat in those webinars and we had positive thoughts, and we outlined the various strategies and things that could be done to help people get through that time and actually move forward. This is no different. This is nowhere near as bad as it was back in March. So if you can get through COVID and you've survived this long, you will be fine. So just make sure that you get out there, use the team of professionals you have around you, make sure you make smart decisions, and just hold tight, because this won't be the last change property investors have to endure. And in business, change is daily, and business owners have to pivot and move away from things and move back to things all the time. Property investment is no different.
Thanks so much, Matt. And as always, being on the show and the guidance you've provided and everything else. And I'm hoping that anyone that's had a watch of this episode, like I said, I know a whole lot of my people in my network have been waiting for this. If there's anything that is still missing, if there's a little bit further insight you still want to know, and an example that's really bespoke to yourself, if I do this with my property, if I have this situation, by all means, reach out to myself, reach out to Matt, or just drop in the comments below. If it's a generic question, please drop in the comments below, because then more people can see it as well. I'll reach out to Matt and go, hey Matt, can you answer these questions? And we'll drop it so that everyone can see it, because we try to cover as much as we can around the policy, but sometimes people have very unique situations around that. But at the end of the day, we've covered as much as we can, and hopefully we've helped you all understand further about these policies that are coming. That's going to change our journey around property for the next couple of months, couple of years, and see what happens. But at the end of the day, as always, I say out there, just, help each other, look out for each other, guide each other where you can, because, sometimes it's hard, sometimes it sucks. It's been almost exactly a year to the day that New Zealand went into our first full lockdown. We're coming out of it, and it just doesn't seem to be easier week on week, because shit just happens. So at the end of the day, make sure you look after, support, love each other, and just respect. And as I always say, be beautiful. Stay safe. Until next time, see ya.